Everyone knows how a regular bank makes money. You deposit your cash, they lend it out, and they keep the difference. But investment banks operate in a completely different universe. They can make billions without taking your deposit or giving out loans. So, what exactly are they doing behind the scenes? Today, let me show you how investment banks really make their money. To understand how they earn money, you first need to know what they really are. Investment banks are financial middlemen for big deals. They help companies raise money, help governments issue bonds, and help large investors trade huge amounts of assets. Think of them as advisors and deal makers. One of their biggest revenue streams is called underwriting. Imagine a company wants to raise money by issuing stocks or bonds. The investment bank steps in, buys those new shares or bonds, and then sells them to investors. They charge a fee for this service. Sometimes the fee is 0.5%, sometimes it's 7%, depending on the deal. For big IPOs, this adds up fast. Next, investment banks get paid to advise on mergers and acquisitions. When two companies want to merge, they need someone to value the business, structure the deal, and negotiate the terms. Investment banks step in as advisors and take a percentage of that deal if it goes through. These fees can range from 1% on smaller deals to tens or even hundreds of millions on large ones. Investment banks also make money by helping big clients trade. When large investors want to buy or sell huge amounts of an asset, the bank acts as a market maker. It buys from one side, sells to the other, and earns a small difference called the spread. With trading volumes in the billions, those small spreads turn into massive profits. Most big investment banks also run asset management arms. They invest money on behalf of pension funds, companies, and wealthy clients. They charge a percentage of assets every year. For example, managing $100 billion at a fee of 1% brings in $1 billion in revenue. Some banks trade with their own money to earn profits, although this is more restricted after 2008. They also run something called prime brokerage. This is a service for hedge funds that includes lending securities, providing leverage, and helping them trade. Prime brokerage fees are a very profitable and steady line of business. All these activities earn a lot of money because investment banks handle massive transactions. A small percentage fee on a $1 billion deal still means tens of millions in revenue. And they work with some of the biggest players in the world, from governments to global corporations to hedge funds. So, how do investment banks make money? They earn fees from deals, they earn spreads from trading, and they earn percentages from managing assets, and they earn revenue from services to large investors. They do not work like your everyday bank at all. Their business model is built on access, expertise, and massive scale. If you enjoy simple, clear breakdowns of how money really works, subscribe and hit the bell. And tell me in the comments which topic you want me to explain next.